Well, hello, and welcome back to Principles of Accounting 2. I'm your host, Dr. B, and today we're going to be talking about relevant costs for decision making for managers. Before we jump into today's lectures, I do want to first and foremost say thank you to all of you for a wonderful semester together. Today is our last day of the fall 2021 semester for this course in terms of lectures. So thank you. Thank you for a wonderful semester together. And over the next few days, you'll be submitting your remaining homework assignments and everything will have to be submitted by December the 5th, which is this coming Sunday. This coming Sunday is the final day that I will be able to accept any work because it is the last day of the semester. I cannot accept anything past the last day of the semester. That is a university policy. It is a very strict policy, and I plan to adhere to that policy. So please, if you have any remaining work, whatever it may be, it is due this Sunday night without exception. That also includes the Chapter 25 homework, which we're about to talk about, and the Chapter 26 homework, which is we'll talk about in the next hour. So please, if you have any remaining work, it is due this Sunday night without exception. I cannot accept anything past this Sunday night. That is a university policy. I will get in trouble otherwise, and I don't like to get in trouble. So let's please, if anything you have remaining that is due, it must be submitted by this Sunday night without exception. I cannot and will not be able to accept it past Sunday night. That also includes what was due this past Sunday night, which most of you did, and I thank you very much for that. This past Sunday, we had the Chapter 24 short essay discussion questions. All I was looking for was a sentence to 3 sentences for each of the 5 questions. I did not yet grade them. I'll be grading them today. So I do appreciate your patience on that. That, as you recall, is worth 10% of your total grade. It's 2 points per question, and there should be a short answer for each question. So if you have not done that yet, that was due this past Sunday night. I will allow you to submit it up until this Sunday night, but again, I cannot and will not be able to accept anything past this Sunday night since it is the final day of courses for the fall 2021 semester. So with that, for this final week of class, Module 4, Week 7, we have the Chapter 25 homework assignment that will accompany the lecture we're about to go through right now, and then we'll have Chapter 26 quiz that will accompany the next chapter, which is the last chapter of this course. So without further ado, let's go ahead and jump on into it. So this discussion that we're about to have is in relationship to cost and making decisions, just as the chapter of the title implies. And I'll give you a couple of examples from my experience in the hotel industry. And I'll also use some of you, our conversations we had before. Some of you are small business owners. So I do want to kind of relate this to you as much as possible. So we're going to talk about a couple of really key important items as it relates to cost, making decisions. Also, a very important thing, setting the sales price. How do we set sales price? What are the decisions behind setting sales price? And what kind of cost information goes into that? So first, let's talk about making decisions. How does management make a decision in the first place? Well, there's a couple of steps that we go through in making decisions, especially in the short run. How do we make decisions in the short run? So here are the steps that management takes to make decisions in the short run. The first step is to define the task and the goal at hand. So what is it that we want to do? or what is our objective? Do we want to increase sales by 5%? How do we do that? Do we want to decrease our overall cost by 10%? How do we do that? So the first step of the decision-making process is to define the task and the goal. The second thing that we need to do is identify two alternatives. Alternative one and alternative two. Sometimes there's more than two, right? But we need to identify the alternatives. 1, 2, 3, 4, etc. Basically what this is what are the alternatives to the decision? For example, if I need to acquire some inventory, do I want to, alternative one, make the inventory myself using raw materials, or buy, alternative two, the finished good already made? So alternative one, do I want to make the product myself? Alternative two, do I want to buy the finished product and then sell it? Those are two alternatives to in business decisions that we make on a regular basis. So the second step in the decision-making process is to identify the alternative courses of action. In the hotel business, I'll show you what this looks like in the next few slides. But one thing that a decision that we had to make, and I told you the story some time ago, was to repair or replace. And I gave the example of the chiller on the top of the building. I'm sure you probably all remember that example. And in that example, the chiller had broke on the roof of the building. And the decision was, alternatives were, do we repair the chiller or do we replace the chiller? And then we ran out the alternative courses of action. The third step in the decision-making process is, of course, to collect all the relevant information. So in the example I just gave with the repair or replace decision with the chiller at the hotel was, what are all the related costs? How much will it cost me to repair it? How long will it last if I repair it? If I decide to replace it, what are the costs to replacing it and how long will it last? So all of the relevant information is step 3. The fourth step, of course, is to select one of the alternative courses of action. So do I go with repair or do I go with replace? And the last step is to analyze the decision that you've made. So if I decided to repair the chiller instead of replacing it, I look at that decision and I say, okay, well, how much did I save? How much cost did I save by repairing it instead of replacing it? Or what will be the ongoing repair costs to that repair? Or what's the ongoing maintenance expense to that repair, right? So that's how we analyze the decision that we made. So those are the 5 steps of the decision-making process. So in the short run, one of the things that we look at is, what are the relevant costs and benefits in the decision-making process? Given the example, I gave the example of the chiller at the hotel. So the alternative 1 is to repair the chiller. Alternative 2 is to replace the chiller. Okay. So I have the 2 alternatives. Now that I know what the 2 alternatives are, I need to understand what are the costs related to the decision that I need to make, repair or replace. So I look at the costs that are applicable to the decision. What's the cost to repairing it? What's the cost to replacing it? I look at the costs that we need to bear on the alternative, on which alternative is going to be selected. I need to look at costs that are unavoidable, and I need to look at future costs. In looking at all of these costs, really what we're talking about are 3 different types of costs. The first is called a sunk cost. A sunk cost simply means it's a cost that we cannot avoid, and it's a cost that we need to make regardless, and it's something that we cannot recover. I cannot recover a sunk cost. It's like, oh, it cost me, $10 million. Okay, that's gone. That's a sunk cost. It's a cost that we cannot recover. We'll talk a little bit more about that here in the future slides. The second type of cost is called an out-of-pocket cost. That's a very generic term, out-of-pocket cost. I'm sure you probably heard this before. It simply means I'm paying the cost up front. And then the third is called an opportunity cost. We've talked a little bit about opportunity cost in previous chapters, and what it simply means is it is the opportunity foregone, the cost of the opportunity foregone. And we'll talk about those three types of costs in depth. So sunk costs, again, are costs that are in the past that can't be changed. It's a loss that can't be recovered. The sunk cost. It's what we call a sinking fund. Some of us have this thing called a sinking fund in our budget. And a sinking fund is simply I'm saving money that I'm going to need to spend on something that I need to do regardless of any decisions. I call it a sinking fund. Or that's when you're saving up the cash that you're going to spend on something you cannot control. In my example I'd like to use for this is probably taxes. That's something that you're going to spend money regardless. The other type of fund we talked about is out of pocket. This is upfront cost that and that's why they call it out of pocket, right? You take it out of your pocket and you pay it right then and there. It's upfront payment. And that is, it's an interesting concept because with out-of-pocket costs or out-of-pocket expenses, it's relevant to the decision that you're making because you're paying for something up front. So it's an out-of-pocket expense. The opportunity cost, this is the cost of what's given up. And it's based on the decision that you're making. So the repair or in my example, do I repair the chiller or alternative one, repair the chiller, alternative two, replace the chiller. The opportunity cost is the cost of the alternative that I did not select in the decision-making process, in that decision. So if I went with alternative one, which is repair the chiller, then the opportunity cost would be the cost of replacement. And so that's what an opportunity cost simply means. It's the cost foregone in that decision. Another way of, in another example of an opportunity cost that I believe we talked about earlier on, in fact, it may have been Principles of Accounting 1, I don't remember, but we talked about this idea of you're going to school, right? So you're a student, your opportunity cost is the amount of that you would earn if you were working during these hours that you're going to school. That is the opportunity cost. It's important that regardless of the decision, management should always consider this thing called relevant benefits. Relevant benefits. What is the benefit of repairing versus replacing? What is the benefit of replacing versus repairing, etc.? What is the benefit? So with the decision-making concept in mind in the 5 steps to decision-making, I want to talk about a couple of key decisions that you may have to make at some point in your life, especially for those of you who are you have a small business or you're thinking about starting a small business. These are the types of decisions that we make on a regular basis, especially for those of you who, again, who have that small business. So the first business decision I want to talk about is the make or buy decision. If I have a business selling, let me think about this for a second. What am I selling? Let's say I am selling calculators. Okay, that's my business. I sell calculators. I also make calculators. Okay, let's say I'm Texas Instruments. I make and sell calculators. All right. And I have a retail store where I sell the calculators. There are a couple of decisions I need to make with respect to inventory. And the first of those decisions is, do I make the inventory myself, or do I buy the inventory from someone else and then sell it? That's what we call the make or buy decision. Now we know that if we make a piece of inventory to sell, there are three primary costs associated with that inventory. And that is direct materials, direct labor, and factory overhead. That is the cost of making a product. We know that. We've been talking about that for the past 7 weeks. So direct materials, direct labor, factory overhead equal the total cost of making a product. So that's the make part of our decision. If we know what those costs are, this is the gathering step, cost gathering step of the decision-making process. If we know what those costs are, I can also make the decision to buy the calculator that I need to sell. So I need to know what the cost to me is to buy that calculator from a vendor and then sell it myself. So the cost of making a product, direct labor, direct material, factory overhead. The cost of buying a product is the cost of the product, right? To purchase it from your vendor. So the decision part, alternative one, do I make the product? Alternative two, do I buy the product? So alternative one, make. The related costs associated with the make is direct material, direct labor, factory overhead. With alternative two, do I buy the calculator and then sell it? In that case, the cost is the cost of purchasing it, the calculator, the cost of keeping it in inventory, cost of getting it shipped to you. What's your total cost when you buy it? And then we got to figure out, okay, which of those makes the most sense for my company? And so we look at that in the decision-making process of making the product or buying the product. So here's another example. We have a company that makes parts, okay? And this company, we can make a part for, let's say it's for a car. Let's say it's like a, it's not an alternator because that costs more than $1, I'm sure. Let's say it, Pavle, what do you think here? What would be like a
Maybe like wipers, or I don't know.
Yeah, okay, I like that one. Let's say it's a set of wipers, part number 417. So our company, Fast Track, that's cute. We make wipers, okay, and part number 417 is a set of wipers, and we're going to assign a overhead of 100% of the direct labor. So so we have fixed factory overhead. We'll say that's our overhead rate. Our overhead rate's 100% of labor. Predetermined factory overhead rate. It's a single plant-wide rate method. For those of you keeping track. So I look at the cost of making this set of wipers, parts 417. It costs 45 cents in direct materials. That's the rubber, the plastic. Labor cost me 50 cents per pair of wiper blades, part 417. My factory overhead is 50 cents. It's 100% of direct labor is my predetermined factory overhead rate. So giving me a total cost of $1.45 to make part 417, which is a pair of wiper blades in our example. Okay, so if it costs me to make it, what did we say? $1.45. I can also buy those wiper blades from Michelin for $1.20. Now we have to figure out the overhead that we would eliminate before we buy the part. So we need to eliminate 25 cents per unit of overhead to make the total cost of making the component. It's less than the purchase price of $1.20. So the reason for this elimination of overhead is because if I were to allocate the purchase, it would make that difference of 25 cents. So, of course, Lynette, did you have a question? Are you okay? Good. So, of course, the decision is, Lynette.
Yeah, I'm here.
Okay, what's up?
No, I'm sorry. I think I'm pushing buttons and I shouldn't be. I'm sorry.
Hey, no worries. That's okay. It's all good.
Did you hear my question?
I did not hear your question, no.
Oh, I thought you heard it. I'm sorry.
That's okay.
You said you want to allocate the money. So we allocate that money that we say we allocated where to. That's what I'm saying. Then I understand exactly what you're talking about. You said we're allocated, and it would make up for the overhead. Where we allocate, where are we placing that money?
Sure.
Or
Great question. Thank you for asking. So if in the make or buy decision, if I were to purchase the product from Michelin instead of the wiper blades from Michelin instead of making them myself, I would still need to allocate overhead to that purchase. And the reason for that is because I still need to keep that in my inventory in my warehouse. So in order to make the decision fair, I would reduce my overhead cost in the make side by 25 cents in order to identify or allocate that overhead to the buy part. Does that make sense? In other words, if I'm going to purchase the inventory, I still have carrying costs of that purchase. I still have to put that set of wiper blades in my warehouse, which is a part of overhead. So therefore, I will reduce my overhead to make it in order to compensate or to apply that difference.
I get it. I'm looking at it as we still balancing out. It's to balance it out. That's how I'm understanding
Exactly.
it. But okay.
That's
Yeah.
exactly right. That's the best way to think about it. Yes, it's like balancing it out. 100% right.
Okay.
Right.
All right. Thank you.
You're very welcome. So in looking at this decision, what do you think? Do we make it or buy it? 45 cents labor, materials, 50 cents labor, 20 cents overhead, $1.15 to make, or do we buy it at $1.20?
I
Right.
want to say to make.
To make, yeah. Yeah, absolutely.
I say make too.
Yeah, and the simple reason, of course, is it costs me less to make it than it does to buy it.
Yeah, it's like 5 cents, but that does add up.
That 5 cents goes a long way when we're talking about millions of sets of wiper blades. Exactly right. Very good. So that's make or buy. And make or buy, again, for those of you who are in business or thinking about going into business, and you're looking at either manufacturing or retailing, or both for that matter, that is a decision that you might be confronted with. So these types of exercises are useful in that instance. And the next one I want to look at is the good old sell or process further. Sell or process further is the next decision that managers make on a regular basis. And what it simply means is if I'm in manufacturing, okay.
Professor, I have a question.
Yes.
The
Please.
exercises, those aren't mandatory, are they?
I'm sorry?
The exercises that you give us throughout the chapters, are those mandatory or are those just
No,
like practice?
no. They're just there to help you. They're
Okay, thank you.
just practice. Yep.
Thank you.
Yep. Thank you for asking. In business, if we're in manufacturing, we oftentimes have to make a decision whether to sell it as it is or process it further. What do I mean by that? If, let's say, we are in the oil business, okay? Let's say we're Exxon or Chevron or whoever you like. So we're in the oil business, and we are drilling oil from the ground, getting the oil, putting it in barrels, and then we do something with that oil. We don't just, we could just sell it as it is to a different refinery, or we can refine it ourselves and turn it into kerosene, gasoline, or other petroleum products. So that's the decision that we look at in this sell or process it further. I can sell the oil as it is in the barrel after I pumped it out of the ground, or I can process it further into kerosene, gasoline, or some other petroleum product. And when I process oil, the way it works is the raw oil, gets shipped to a refinery. And that refinery, they refine the oil. That's why they call it a refinery. They refine it. What does it mean to refine? They process it. Okay. And when they're processing oil, what they're doing is they're thinning it out. They're heating it up. They're basically converting it. They're converting it from raw oil to kerosene, gasoline, other petroleum products. Now, the decision is, do we sell the oil as it is, or do we process it further into another product, such as kerosene, gasoline, or some other petroleum product? The general rule that we take here is that if we process it, we'll process it further if it generates additional revenue over the incremental cost. What does that mean? If my additional, so incremental means additional, right? So if my additional revenue is greater than my additional cost by processing it further, I'll probably process it further. So here's another example. Our company has 40,000 units of a partially completed product. We'll say let's stick with the example of oil. I have 40,000 partially completed units of raw oil. My processing costs are $30,000 so far. The 40,000 unfinished units can be sold as is, just barrels of oil, for $50,000. That'll give me a revenue of $10,000. Or I can further process the oil and create kerosene, gasoline, and additional petroleum products. Processing the units will cost an additional $80,000. And my additional revenue would be, or my total revenue would be $150,000. My question to you is, do I further process it? Why or why not? Who wants to answer that question? Do I further
I think
process the oil?
you should, because there is a profit to make, and
So how much
at least
profit would it be? So if I process it further, it
Mhm.
costs an additional $80,000. It will yield a total revenue of $150,000. So what is my profit here, or what is my revenue?
one, you will have a customer and a brand that will be selling mostly, and the second one you will be making, you will like 2x your cost, and I think it should be processing, I believe, because you can create different products to sell too. So
Right. Excellent point. Yeah, you're right. So the short answer is yes. I would definitely process it further.
Professor, if I look at
Yeah.
this, the profit would be 150,000 minus 80,000, and that would give me my profit.
Almost. So if we look at the full paragraph or the full both parts, okay? So take a look. If I sell it as is, meaning raw oil, my revenue will be $10,000. How did I get that? If I sell it for 50, I'm sorry, it'll be 20,000. If I sell it for 50 and it costs me 30, the difference is 20,000. Okay, so my gross profit will be $20,000. If I process it further, it would be an additional cost of 80,000, and my total revenue would be 150. So, in order to figure out what my total gross profit would be if I process it further, I take 80,000 plus my 20,000 original. That gives me $100,000 in total cost. Okay. Wait, I'm sorry, I did that wrong. 80,000 plus my original processing cost of 30,000. That gets me a total cost of 110,000. But if my total revenue is 150,
You have 40,000 in profit, right? Gross profit.
you got it. It'd be $140,000 in gross profit. And that's over what I would have originally got, which would have only been 20,000 in gross profit.
so you will get Nate $40,000.
I would get an extra. So my yes, yep. So the short answer is yes. I would definitely process it further because my gross profit would be greater than my original gross profit. So So look at it as alternatives, right? Alternative one is I sell the oil barrels as is. So 50,000 would be my revenue. It would cost me 30,000. So my gross profit for alternative one is 20,000. Alternative two, I further process it, and my total revenue would be 150,000. 150,000 minus the total cost, because remember, when I process it further, I'm adding cost to what I already did. So 80,000 plus the 30,000 is a total cost of 110. 150,000 minus 110,000 gets me 40,000. Right?
40,000, yeah, 40,000 in profit.
And that's alternative two. So alternative two, my gross profit is 40,000. Alternative one, my gross profit is $20,000. So clearly, alternative two, which is processing it further, would be the right thing to do here.
Yeah, but so if you still, is it quick to just make a $40,000 in quick, or you gonna be like based on the customer service and the customer constantly selling that product? It would be a good company that can make good money for the long time, you know?
Exactly. Yeah, that's a very accurate point. Yeah. So in the long run, it would make sense to process it further because if you look at the difference, I mean, really, we're doubling the gross profit, right, by processing it further, and that's ultimately what it comes down to, regardless of what's happening on the customer end. Yeah, excellent points. Great conversation. Awesome. Thank you. So yeah, of course, the decision is going to be: is the added revenue from selling the finished products exceed the cost of finishing them? The answer is, of course, yes. So looking at what we just did, right? So we looked at the incremental process: 150,000 minus the 80,000, 70,000, 50,000 would be that. And this is just looking at the revenue side of things. We took it a step further and looked at gross profit, which is really what you should be doing, is looking at the gross profit, because the gross profit's going to tell us the ultimate difference. So if we sell it as is, as it says right here at the very bottom, it yields an additional $20,000 of income. Because if you take your revenue and then subtract out your expenses, you're going to get your gross profit, right? So 50,000 minus 30 is 20. 150,000 minus 80 is 70, minus the original 30. You're looking at 40,000 for your gross profit. And that's really the best way of this type of decision, is to include those costs. But of course, sometimes they don't always include them. The 30,000. So the 30,000. That original 30,000, it's considered to be a sunk cost, which typically we don't include in an analysis because it's a cost that is going to be paid regardless of which decision we're making. So, in looking at the decision, in yielding that additional 20,000 in income by processing the oil further, it's processing it further, of course, is going to be the best decision, right? Because we're getting that additional 20,000 in incremental income. That's a nice, in my opinion, I like that type of decision making because, from that perspective, especially if you make products that are similar, and you further process your raw materials to make an additional product. I mean, that's the type of decision process that you would have to go through. Which is fun. It's interesting. Here's another decision that managers have to commonly make in manufacturing. It's called scrap or rework it. So, let me think of an example here. Oh, our wiper blades. Okay, our wiper blades, right? So we make wiper blades. That's what our company does. So sometimes the wiper blades are defective. It happens. Manufacturing, it's not perfect. So we got 10,000 defective wiper blades. They cost $1 each to make them. So there's $10,000 in defective merchandise. Now here's a decision. I can either scrap those defective wiper blades, meaning, sell the rubber and the plastic, scrap it, right? I can sell the rubber and the plastic, and I could get 40 cents each. Or I can rework those wiper blades, so to the point where they're no longer defective, for an additional 80 cents cost per unit. If I rework them, then I can resell those wiper blades at the normal sales price of $1.50. So let's take a look. I can either scrap the defective wiper blades per unit, it's 40 cents. Or I can rework the wiper blades. It'll cost me an additional 80 cents out of my pocket to get them fixed up, to resell them. I can resell them at the original price of $1.50. Cost me an additional 80 cents.
Are you gonna lose the money though?
It may be. So
30 cents a unit?
but when you lose, you'll receive less in terms of gross profit. Yeah. Because it'll cost you more, right? So your cost of goods sold will increase.
What if you can sell a little bit higher than the actual price?
Right, exactly. Yep. And so oftentimes what happens in the real world scenario, think of you guys know what refurbished means, right? Refurbished.
Yeah.
So let's say we have an electronics company and we refurbish electronic pieces. Typically, normally, what happens in real life is I'm not going to resell it for the same price. I'll sell it as refurbished, right? So it's typically a lower price than if it's brand new and was not defective, right? So in the real world, yeah, the sales price will probably be less, and but the difference here is that, and the two alternatives that we're looking at is, do I scrap it, meaning I'm going to throw out these wiper blades, they no longer work, and I'm just going to get the scrap value. I'll get my 40 cents by scrapping it. I'll scrap the rubber and the plastic. Versus reworking it, it'll cost me an additional 80 cents, but I can resell it for $1.50. So in this decision, alternative 1, scrap it. Alternative 2, rework it. The incremental income, if I scrap it, it's just 40 cents. If I rework it, I could get 70 cents per unit. So the company probably would rework it here because they're still getting more in terms of incremental income per unit. But again, in the real world, they're probably not going to sell a reworked unit at the same price as if it wasn't. That's normally not how that works. All right. Now I want to talk, we're going to switch gears a little bit here. And I want to talk to you about sales prices. Setting your sales price involves a lot of key pieces. Of course, you need to know what your costs are. That's, probably the most important thing. But in addition to knowing your costs, you need to also understand your sales mix. You probably heard about this before. Hopefully you've heard about this before. Hopefully you heard about this in your introduction to business class. I'm hoping that you heard about this in your introduction to business class. If you haven't, this is definitely something that you should know. It's called a sales mix. Most companies sell more than just one product. I think we know that. Some maybe don't. Most companies sell more than one product. They sell a variety of products. And some of these products are going to be more profitable than the other ones that they sell. That makes perfect sense. That's very typical. In most companies, management will concentrate at their sales efforts on the most profitable products. It's like, for example, let's say you're in the hotel business and you have a certain type of room that sells that is more profitable than others. For example, let's say you have a set of junior presidential suites at your hotel, or suites in general. We in the hotel business know that we can make a lot of profit by selling those suites per night, right? More than we could at a regular room of the hotel. So management will focus on renting out those suites more than they would the regular rooms because we want to make more profit. That makes perfect sense. The same can be said with pretty much everything. Cars, for example. We know that there are certain car models that are more profitable than others. So they'll try to sell you those cars versus the standard ones. You know, the ones with the more bells and whistles, they're more profitable than the base model. So they'll try to sell you the higher model. It's very normal in business. You know, management concentrates on selling the products that are the most profitable. There's a trade-off, obviously, with doing that, and we'll talk a little bit about it in the sales mix. Now here's the thing. Let's say we make cars and we sell cars, okay? If I focus my attention on making cars that are more profitable rather than the base model ones, I'm going to end up limiting the amount of production for the base model. When management does that, we're identifying the most profitable combination of product of cars. This is called a sales mix. A sales mix is a combination of different products that make the most profit. And we focus on this thing called the contribution margin per unit. And that contribution margin per unit added together with all of units that we're selling, types of units that we're selling, gives us the contribution per margin of scale. So here's an example. Our company, we sell two types of wiper blades. We have wiper blade A and wiper blade B. Let's say that wiper blade A is our standard wiper blades. Wiper blade B is the Rain-X, the fancy one. And we use the same type of machinery to make both types of wiper blades. So here's some data. For wiper blade A, the standard wiper blades, we sell them at $5 a set. The cost of manufacturing each set is $3.50 for the standard. Yeah. Wiper blade B, that's the one with the Rain-X, we sell them for $7.50. And the total variable cost on those is $5.50. So in our sales mix, we have wiper blade A, wiper blade B. B is the one with the Rain-X. It's the fancier model. So let's take a look at the first thing we want to do to understand what is our sales mix. We identify our contribution margin per unit. And you all remember how to do that, right? You take your sales price minus your variable cost. And we do that for each type of product that we sell. So for product A, $5 minus $3.50 is $1.50 contribution margin. For product B, $7.50 minus $5.50 is a $2 contribution margin. Okay, that's good. But now we need to also factor in the hours, machine hours. Because based off of this information alone, so far product B looks great, right? Oh, $2 per contribution per unit. That's fantastic. But that's not the whole story. We got to figure out what is the contribution per machine hour. Because we know that with product B, it's going to take longer to make them. Why does it take longer? Because we got the Rain-X, we got the added material. It takes longer to make it than it does the standard wiper blades product A. So let's take a look. For product A, it takes 1 hour to make this set of wiper blades. Product B, it takes 2 hours to make this set of wiper blades. So with that, what we do is we take the contribution margin per unit divided by the machine hours per unit to get our contribution margin per machine hour. So for product A, our base model, it's $1.50 divided by 1 hour is $1.50. For product B, $2 contribution margin divided by 2 hours of machine hours per unit equals $1 contribution margin per machine hour. So now, based off of this additional information, product A gives me the best contribution margin. So what do I do as a manager? I'm going to focus my attention on product A because my contribution margin per machine hour is higher than product B. And as a manager, I'm always focused in which product is going to get me the most profit. So I focus on that product and I make more of that product to be able to sell more of that product because it gives me a higher contribution margin. So when we talk about sales mix, whichever, if you're looking at product A, product B, it's going to be whichever one has the highest contribution margin. Another key decision that managers make is looking at segments of the business. And sometimes we have to discontinue products or discontinue segments of our business. And that decision of discontinuing or eliminating is going to have an impact on our revenue and expenses. Sometimes we can avoid expenses when we remove a segment from our company. What do I mean by that? Let's say we manufacture wiper blades, product A and product B. Product B, let's say we want to eliminate product B. We want to remove it from our company. Well, I can avoid some expenses here. I can avoid direct materials and direct labor for making that wiper blade. But what I cannot avoid is factory overhead. I'm still going to have an electric bill. I'm still going to have to manage your salaries. I'm still going to have rent. Those are unavoidable expenses. I'm still going to incur those expenses even if I eliminate making product B. So avoidable expenses are ones that I would not have if I eliminate the product, if I stop making product B. The unavoidable expenses that I'm still going to have are going to be my fixed factory overhead. I'm still going to have to pay my rent, utilities, salaries, etc. So let's say our company, in addition to making wiper blades, we also make treadmills. Okay. But our treadmills ain't doing well. They're not selling as well. Who knows? People don't like to run, I guess. We have an operating loss of $500 last year in our treadmill sales. That's not good. We have a $500 loss for that segment. So here's our treadmills. We make treadmills, I guess, in addition to our wiper blades. And I want to look at, I lost $500 last year selling treadmills. Why is that? Let's see it. My sales were $47,800. Total cost of goods sold was $30,000. Gross profit was $17,800. Then I had my direct expenses, direct labor $7,900, depreciation $200. Then I had my indirect expenses, my rent, utilities, advertising, insurance, shared space, purchasing expenses, giving me a total operating income loss of $500 from my treadmill sales. So I'm thinking I want to stop selling these treadmills. Well, there are some avoidable expenses. These are the expenses that I will not incur if I stop selling treadmills. I won't have cost of goods sold because I'm not selling them anymore. I won't have direct wages because I'm not making them anymore. I'm still going to have depreciation on my equipment. Okay, so that's an unavoidable expenses, depreciation. I'm still going to have depreciation. I'm still going to have rent and utilities, even if I stop making my treadmills. I won't have to advertise for them anymore, so I can avoid the $400 in advertising. I'm still going to have some insurance, because I have to insure the rest of my building, even if I've stopped making the treadmills. I'm still going to have the office expenses, and I'm still going to have some purchasing expenses. So I can avoid a total of $41,800 in expenses if I stop making treadmills. But I'm still going to have to pay $6,500 in the expenses I can't avoid. Meaning I still have to pay rent. And I still got to pay all this other stuff, even if I stop making the treadmills. I'm still going to have to shovel out $6,500. So do I eliminate making treadmills or not? Well, if I stop selling them, I'm going to have a decrease in total income of $6,000. Why is that? I have sales $47,800. I have avoidable expenses of $41,800. So sales minus avoidable expenses will give me a decrease in total income of $6,000. $6,000 is a lot more than $500 loss. So do we eliminate the treadmill division or not? What do you think? Should we stop making treadmills or keep making them? What do you all think? And then I'm going to ask you why. If I stop making the treadmills, why am I going to do that? Now remember, if I stop making them, I stop selling them, I'm going to have a decrease in total income of $6,000, which is a lot greater of a loss than $500. So what do I do?
I would say stop making them. And I will also, not only would I base it upon the numbers, but I will also base it upon what is actually trending in the finance world with the stock markets, also what it is that people are buying. Maybe it's this one specific type of treadmill. Maybe it's a new treadmill that people are buying with the LCD flat screen. I don't know, but I will do further research as to see exactly why they're not buying this treadmill. And maybe we can do some production arrangements so that we can
Right.
be profitable again.
It's-
That's what I would do.
That's a pretty wise decision, actually. I like your logic. I like your logic a lot behind that. That's
Yeah.
probably that might be what I do, but I'm not sure yet. I'm not sure yet.
Okay.
But I like it. Any other thoughts? Any contradicting thoughts? All right, Lynette, I'm going to give you my thought on this. Here's what I would do for me. I would continue to make the treadmills for some time. Okay, here's why. Because I agree with you. I think that, we can probably either turn it around and sell more, or consider changing our product mix, right? I agree with your logic. I do wholeheartedly. In fact, I think it's a very sound reasoning. But the reason why I disagree with you to some degree is that I don't want to just stop making the treadmills. Although, yeah, I'm losing $500 total by continuing to sell treadmills. If I stop making them treadmills, I'm still going to have my fixed costs. I still got to pay the rent. I still got to do the depreciation. I still got some shared expenses that I have to maintain. So I'm going to keep making the treadmills for a little bit of time until I find a replacement product. Go ahead, Marina. What do you think?
Does this also involve with like fluctuation too? Like maybe the product is higher now, but then it'll go down later to make the treadmill?
So, great question. It should. The decision should include that. We're just looking at 1 year's worth of data. The reality is, and you're right, there might be higher years than others, and let's just say it's a slow year, people just don't want to exercise. That could be true. So the fluctuation, yeah, it's something that needs to be taken into consideration in this decision in the long run.
Yeah, that's why I said you have to look and see. You have to actually do your homework
That's right.
before. If you say stop making because you don't want to increase in loss of profit, so do
Right.
your homework. Actually, the markets, import exports, the tariffs that they're putting slapping on each other because they mad at each other. You know how the presidents are. All of that actually affects our bottom line. So you do have to do your research, see what it is, or the reason why the products are not selling, or sometimes maybe just lower the product. At least we can break even versus
Exactly.
losing some money.
You're
Yeah.
exactly right. You're exactly right. Yeah, and that's the reality is with all of these decisions that we're talking about today. The reality is you need to, as Lynette just said, you really do need to take pretty much every factor into consideration. And even as Marina brought up the logic behind the fluctuating market in terms of prices and purchases and et cetera. The reality is you need to look at the whole picture, not just, what happened this year? I didn't sell as many as I wanted to. No, let's stop making it. It's like, no. You gotta really look at the whole picture. And as you said, do your homework. But just from the exercise perspective of going through these examples, I think is helpful for us to understand the basic concept of it. But yeah, this is a good discussion. So my next favorite one. Go ahead, Marina. Marina, were you going to add to it? You're okay.
No, sorry.
That's all right. No worries. So my next favorite decision is, well, do I keep this thing or do I replace it? That's always a fun decision. Machinery. Oh man, machinery. Let me tell you, sometimes they cost you more money in the long run than not. So, do I keep or replace some equipment? And let's look at this example. Our company, we make wiper blades. We assign 100% of our overhead to match our direct labor cost. We know that because we talked about that. 100%. It's a fixed rate. Okay. So I'm thinking about buying a new piece of machinery because my old one is, it's starting to get a little worn out and it's starting to break down a little bit more. And, it's just not living up to its expectations. So I got to look at the decision to keep it, the current machine, or replace it. Now, of course, there's some basic considerations here. What does it cost to buy a new piece of machinery? In our example, it's $100,000. If I were to sell my old machinery and get, a little bit of cash from that, what kind of cash would I get from it? About $25,000. Okay, not bad. Well, if I were to purchase this new piece of machinery, what would happen to my total variable costs? Well, there might be a reduction. Total variable cost, $72,000. Now, what would happen to my net income if I purchase this new piece of machinery? Well, it'll drop by $3,000. Okay. So interesting. Now, looking at this data, we can say to replace or not to replace. Now, your textbook will say, no, don't replace it because there's going to be a decrease in net income. That may be true for a short amount of time. Okay. Just as Lynette and Marina, just as we were talking about, you got to look at the whole picture. If I got this old piece of machinery and it keeps breaking down and, it's limping along here, eventually it's going to cost me more, right? So sometimes you got to take the hit up front. It's like, I might lose $3,000 this year. Yeah. You can make it up next year. So that, as we talked about, your book's going to say, if there's a decrease in income, don't replace it. That's textbook. Real life says you got to look at all of the factors here. If I replace that thing, what's going to happen to my cost in the long run? If I don't replace it, what's going to happen to my cost in the long run? So, textbook, yeah, don't replace it because there's a decrease in net income. Real life, you might want to replace it down the road. Okay, now my favorite discussion, how do we set prices using cost information? Setting the sales price of your products is probably one of the most important things you'll ever do in business. Why is that? Because the price that you put in is going to dictate how much profit you're going to make. Okay. In business, we're always concerned about profit. Why? Because that's how we stay in business. If your business is not profitable, you will go out of business. Simple. Yeah. Every business needs to make a profit. That's how the business stays in business. Okay. It needs to at least break even, but it really should be making a profit. Okay. If you keep losing money year over year over year, you're going to go out of business. I mean, that's just simple mathematics, right? It's like, I can't keep shoveling out all these expenses and not getting enough revenue to cover them. Obviously. So we need to set our sales prices for our products and services to the point where we're earning profit. There's this thing called target profit. It's how much does the owner want to make in terms of profit. That's called target profit. That's based off of the return on the investment. And in setting my price, I need to take a couple things into consideration. The customer demand. How many people want to buy it? What price do they want to pay for it? How will they react if the price goes up or down? Competition. If there's a lot of the same product on the market, it's very competitive, and therefore I need to be able to set my sales price similar to my competitors in order to remain competitive. It's like that hotel in DC that sets their rack rate at $500 a night when all the hotels around them are setting their rack rate at $300 a night. It's like, hello, what do you think? Well, I'm pretty sure people are going to gravitate to the lower price, right? For a very comparable product, right? Differentiation. The price of the product or products should be differentiated, and there should be control over the sales price, setting the sales price. Product life cycle is another thing to take into consideration. If I set my sales price high at the very beginning, when it's a brand new product, let's say iPhone 47 or whatever number they're up to now. Your iPhone 47, you set the sales price real high. When 48 comes out, you drop your sales price for 47 down. So forth and so on. It's the same concept works, right? It's a product life cycle. Cell phones have a short life cycle. They're replaced with newer models each year. So understanding the product life cycle is also important when setting sales price. One of the methods that we use when we set our sales price is called the cost plus method. When I set a sales price for my product, how much am I going to sell this for? I look at this thing called cost plus. It's where I take my total cost and then add in my desired profit for that product. If it costs me total cost, this is your raw materials plus direct labor plus factory overhead, my total cost of the product. I find my total cost, and then I add in the profit I want to make from it. That's called cost plus. So the first step is to determine the total cost of the product. Second step is to determine the markup per unit times the markup percentage. And then the third step is to determine the sales price. Markup. Markup is marking up the price. That's what we call it, markup. Marking up the price. Raising the price. To the sales price. It's very important that we cover our total cost. Here's an example. My total cost. My product cost plus my selling administrative expenses. That's how we get it sold, right? That's my total cost. In this example, it's $700,000. It's the product cost, $44, times number of units expected to be sold, 10,000. Plus selling administrative expenses, all that good stuff, 700,000, okay? So it's total cost, 700,000. I expect to sell and produce 10,000 units. That gets me a total cost per unit of 70. 700,000 divided by 10,000, 70. Now I figure out what's the markup. Well, how much profit do I want to make? My company says I want to make 20% profit on each product that I sell. So if my total cost is 70, I multiply that by 20%. That means I need an additional $14 per unit in order to get my 20% target. So 70 plus 14 is a sales price of $84. And that's the process of determining your sales price using the cost plus method. Another way of determining your sales price is through the target costing method. This is where we say, hey, listen, I want to make a total profit of $14 per unit. So how much do I need to sell it at? Okay, here's an example. MP3 players. Yeah, that's funny. All right, MP3 players. There's a market price for MP3 players of $80 per unit. So the market says $80 per unit. That's nice. Our company wants a profit of $14 per unit. So that means we need to reduce our total cost per unit to $66. 80 minus this desired profit of 14 gets us $66. If we want a 14% return on our investment, we would take 14% of our invested assets of $1 million. We would take the target profit of $140,000. That would give us a target profit of $140,000, which means $14 per unit times the 10,000 units that we will sell, $140,000. That also means that our market percentage is $14 desired profit divided by $70 sales price equals 20%. Another method to determining your sales price is called the variable cost method. This is where we look at the variable cost per unit to understand what our sales price would be. We also look at what competition is doing too, but to some degree. So we take our target profit plus our fixed cost, our fixed overhead, plus our fixed selling and administrative expenses, divided by our total variable cost. How do I find total variable cost? It's your cost per your variable costs per unit, direct materials plus direct labor, times the number of units that you plan to sell. That will get you your total variable cost. So your target profit plus your fixed cost divided by your total variable cost equal your percent markup. In this example, 68%. So how much we sell it for? Total variable cost, $50. Plus variable cost times markup equals $84. 50 times 68% plus the 50 equals 84. Remember that order of operations, yeah? Order of operations, very important thing to remember. Do the parentheses first. A couple of other ways to price your products. One's called the value-based pricing. It's where they focus the focus is on value, which is what the customers determine the value of the product to be. Another one's called auction-based pricing, where buyers bid on prices. Again, depends on what you're selling. The third is called dynamic pricing or surge pricing. It's based off of demand and shifting conditions in the marketplace. A couple of special things to consider. Special offers. This is a decision to accept additional business based on incremental cost and incremental revenue. So let's say we have a customer that approaches us and says, hey, we are interested in working a deal with you on wiper blades. And so they give us some information. And if the incremental revenue is greater than the incremental cost, then we would probably accept that new business. And here's the example given. We're at 80% capacity currently in our production of wiper blades. We currently sell 100,000 units. Well, that means we got 20% of room available for additional business. If a buyer wants to purchase additional units from us and export them to another country, of course, there will be an additional revenue and an additional expense with that. A buyer's offering to buy an additional 10,000 units of product, $8.50 per unit, or $1.50 less than the current price. So in other words, they want to buy in bulk, right? So we'll offer them a lower sales price. The offer price is low, but seeing as how we're only at 80% capacity, we have the ability to make that additional 10,000 units for our customer. Do we do it? Why or why not? So in looking at this, since we have the additional 20% capacity, and even at $1.50 at a lower sales price, yeah, the short answer is yeah, we would accept that offer because we have the capacity, and it will give us our additional income would be greater than our additional cost. What about service businesses? Service businesses, they work very similarly. With a service business, of course, it's based off of labor, materials, overhead, plus the desired profit margin with a service business. They compute the rate in terms of hours of direct labor for overhead. Compute the materials markup, overhead costs related to buying, storing, handling materials, etc. That's expressed as a percentage. And then we would estimate the number of labor hours and the total labor material cost for the service. And then you'd repeat those steps for each type of product that we sell. It's time and material pricing. And that's how for example, let's say at your house you got somebody, an electrician, that's going to come down and do some electrical work for you. They'll tell you what their labor cost is. They'll tell you what the materials cost is. And there's a science behind it. There's a reason why they derive the prices that they do. There's a cost for labor and there's a cost for the materials. And so the first thing they do is compute the labor hour using direct labor. Hourly rate plus non-material overhead, giving you hourly conversion cost, plus the profit margin on labor, giving you the total hourly rate that's billed to the customer. Then you have your materials cost, plus percent profit margin, giving you your total materials markup. Then you have the estimate of hours and materials for the job. And then you can create your quote. So that's, so if you ever have it like you could apply this to your personal life too. So like if you have a house and you're like, oh, I'm interested in having a deck built, or I'm interested in having some new electrical put in, or I'm interested in, putting a new water line in, whatever, right? That's how these quotes are developed. So of course they're going to put profit margin on both hours and on the materials. That's how they make profit. That's how they stay in business. And so that's how these these quotes are developed. That, my friends, is the end of our discussion for right now on relevant costs for decision making. Any questions, comments, concerns? We're going to jump into our final chapter here in a few minutes. I just wanted to check with all of you. Do you all want to take a 5-minute break?
Yes, please.
Great. Well, it's currently 12:30. Let's be back here at 12:35. So please take a 5-minute break. Thank you.